Welcome back. Financial Issues, 866-300-9298. If you want to queue your call up, you're welcome to do that, 866-300-9298. Dow futures in positive territory right now. Eurozone inflation falls to the lowest level since 2009. Well, that's a good thing, right? No, that's not a good thing. It's a bad thing. We got to have some inflation, and their inflation dropped to 0.5, a half of 1%. That is dramatically low. It means people aren't buying. It means that there is deflation creeping in, and the Eurozone may be headed for some major deflation. And remember, their economy is as fragile as ours and everybody else's economy, and we're seeing deflation creep in. It could put them in a very, very substantial risk of headed back into recession as a result of that. So there's got to be some concern in the Eurozone. This is the whole 17-block Eurozone. Well, by the way, it didn't. Markets are going up. Nobody cares about reality. Reality is irrelevant. And we have got into such a place of the irrelevancy of reality in the economies, not in the markets, in the economies, that it almost, why even report on this, yet I continue to do it. Gold is going up, so that's good news. I know for a lot of you, gold is going up primarily with the idea that we are going to see some good job numbers come out Friday. Everything for this week is going to be based on the job numbers on Friday. Oil, by the way, back up it's at 101.54, but gold is still in negative territory, or it's still negative today. It looks like it's creeping down a bit, but it's at 1292, so it's trying to get over 13. Silver still at 1990. Agricultural commodities, all negative, with the exception of cotton. So a lot of negative, a lot of red. Oil is going down. That's a good thing, but it's at 101.54. I suspect that might turn around. Gasoline is down dramatically, 0.75% right now. So that's some good news for us. But all in all, when we look at what is going on in in a deflationary time, it is not going to be good for the Eurozone. And I think that we ourselves are going to see some more of this. As, by the way, the consumer sentiment number on Friday, I didn't get a chance to talk about this on Friday, but the consumer sentiment number came in at a 4-month low. Does anybody care? No, nobody cares. Listen, we should only care about consumer sentiment. It should have immediately sent the markets down because it should be the only thing we really care about. And we're starting to see a bit of a trend, and we're seeing consumer sentiment go down to its lowest level in 4 months. It's not huge. It's not some sort of record. It's not catastrophic by any stretch of the imagination, but it's springtime. This isn't a winter effect. It's springtime, and we're seeing consumer sentiment go down. Well, that's not a good thing. I'll tell you, you think it's down now? You wait until next month. And I don't care what anybody says next month. When all these people have to start paying for this Obamacare, and we'll just say for conversation's sake, out of the 6 million, it's 4 million to be generous, because, you know, that's about what it is when you factor out the 17%. So let's just say it's 4 million. When they start having to pay the bill. Where's that money coming from? It's coming from what they would spend on their spring wardrobe, what they would spend for other things in an economy. If you don't think consumer discretionary, consumer sentiment is important, let's not forget 71% of our economy is based on consumer spending. Did the markets budge? No, they don't care. That's a fundamental of the economy. Why am I going to worry about a fundamental of the economy when I've got stock prices that continue to go up and profits are going up in companies' balance sheets, even though their sales aren't? Shouldn't we be worried about sales? Yeah, we should be worried about sales. It means people aren't buying. It goes back to the consumer sentiment thing. But in spite of that, their balance sheets being manipulated are going up. And that's all anybody cares about. It's absolutely amazing to me. This week, the big number is going to be Friday's number. The unemployment rate comes out Friday. It's expected to go down to 6.6% from 6.7%. That's what the street says. They're expecting to add 197,000 jobs. That's what the street says. That's not a bad number, but there are an awful lot of people out there predicting 250. Well, it ought to be 250 because of the bad numbers that we've had for February or January and February. So one would think if that was all related to winter and the cold winter, then one would believe that there is penned up employment to happen in the month of March. So we should easily see 250,000. I'm sitting at around 201. But we should easily see 250,000. I wouldn't be surprised if we had 300, and I wouldn't be surprised if we had 150. I don't care if we have 400. It's not going to be a good number in my mind. So if we have 400, if we have 300, don't expect me to get on the air all jovial because of this good job numbers. And the problem is if we get down to 6.6% unemployment and the unemployment rate continues to go down, the Fed's got a huge problem because the Fed's going to have to figure out what they're going to do about this falling headline number of unemployment. Because at some point in time, if the number is real, now Janet Yellen said last week that she doesn't believe the number is real. Welcome to the club. The problem was the next sentence, something thereabouts, shortly after that, she said, well, the headline number, though, is all we have to go on, and that's what we'll stick with. Well, why? If the headline number is not accurate, why would you do that? And she's either going to have to walk that back or the Fed's going to be faced sooner than they think at this pace of an unemployment rate going down, if it does go down, with raising rates. They're going to have to. Suppose we get somewhere near normalized unemployment. We're almost there now. Suppose we get below 6. Suppose we get a 5.9. We've never had a low interest rate environment and a 5.9% unemployment rate. Never. What are they going to do? It's going to be very interesting. Tomorrow we get out the manufacturing index. That's expected to rise a bit. The manufacturing index is supposed to go from 53.2 to 53.9. That's what the consensus is. We'll wait and see. Construction spending expecting to be negative, which is a little odd for the month of March, but nevertheless, there's still been some cold weather. We could probably get another month of blame out of the cold weather for construction spending. Construction spending being an extremely important number for me. It's the largest employer in the nation and something we ought to be concerned about. Vehicle sales are expected to inch up a bit for the month of March. Factory orders expected to go up to 1.2% from a minus 0.7, that would be a huge swing. That's almost a 2% swing. So that would be pretty big if that happens. That's coming out Wednesday. Thursday, trade deficit supposed to increase, supposed to get bigger, headed towards the $4 billion mark. It's at 39. They're expected 39.6 from 39.1. We'll wait and see. We don't know what that's going to look like. ISM non-manufacturing, the service sector number, that's also supposed to go up to 53.2 from 51.6. I find that hard to believe because that has been the sector that has been least affected by the cold weather to a certain extent. And then, of course, we get the payroll numbers. They're expecting 197. Remember last month we had 175. The month before that we were 160. What was it, 163 or something thereabouts? And the unemployment rate expected to go down to 6.7%. So if consumer sentiment, I'll say what I say every month, if consumer sentiment number is up or consumer sentiment is decent, in which it is, at least the government consumer sentiment number, and if that is okay, and if people really believe the economy is recovering and the economy is getting better, the fundamentals of the economy, not the market, getting better, then it always leads to more people getting into the workforce. If more people get into the workforce, that means the labor participation rate has to go up. If the labor participation rate goes up, then the unemployment rate will have to go up. So if the economy is truly recovering, if jobs are truly being created, which is comical to say they are, like Larry Summers did. I mean, it's comical. What is he talking about? But it's comical for him to say that. But, it is nonetheless, if that's the case, then the unemployment rate should be going up. And the going up unemployment rate in this case ought to be a good thing because it means more people coming back into the labor force. I would welcome a 7% unemployment rate. You know, that's something that I could consider pretty good news. But you're not the headline number. I'd rather see a 7% number because the labor participation rate is picking up. It means that the consumer confidence numbers, that people are really confident, that they're the people that had written it off or have given up or have stopped looking are now entering back in to this idea of looking for a job, and that's going to be very good news. If that happens, I'm not holding my breath. Because everybody knows from a political standpoint, the only thing anybody's thinking about is this headline number. Anyway, it'll be interesting, but that's the thing. Friday, everybody's waiting for. So all the other numbers between now and Friday are probably going to be insignificant compared to what we actually get. The markets are extremely happy this morning, just so you know. Very happy. The Dow's up 113, and everything's just great. So we're going to have to wait and see. There's a lot of comments out there about the interview, 60 Minutes interview yesterday, talking about this, the book, talking about what Michael Lewis was talking about in that, hey, is this a market rigged? He says it is. He talked about high-frequency trading. If you don't understand that, you've got a question about it, you can ask me. But that's what he's talking about. And he said, the market's rigged, that it's driving. There's nothing illegal about it. They're certainly looking into it. But that's just one tiny little thing. I don't know that the market's rigged, but I believe it's manipulated. There's no getting around that. It has been for the last 10 years, but when it all shakes out, usually the winners and losers are pretty accurate. But it's very, very interesting if you look at what is happening within corporate insiders. You find out that, rigged or not, corporate insiders are sellers, not net buyers of stock, corporate insiders. Now, they were corporate insiders were right in 2007 to be net sellers. I was a net seller. I was just blessed by the Lord in having that foresight and was able to get out. I got out a lot. I went about 40% cash in late 2007 after Bear Stearns went down, and it did go down. After Bear Stearns went down and got bailed out in March, I was about 70% cash. So I rode into the storm 70% cash, so I did fairly well. But there were a lot of corporate insiders that did the same thing. And now they're doing it again, and nobody seems to care about it or paying any attention to it. But who do you trust? Do you entrust some person on Wall Street to make predictions about a particular company? Do you expect me? Do you trust me to make a good pick on a stock more than you would a corporate insider? Let's say you knew a senior VP at a big oil company. Would you believe what he said about their stock, or would you believe what I said? If I were you, I would believe what he said. He's intricately involved in that corporation and their activities. He's got a better feel than anybody else does. But we're not going to pay attention to that. And there's no reason to pay attention to it from the standpoint that, listen, do we care about the fundamentals of the economy? I think this market has clearly sent the message that the fundamentals of the economy are irrelevant in this day and age. When in fact, since the inception of the market, the fundamentals of the economy have been exactly the only thing relevant, because it was the fundamentals of the economy that drove the market. The economy was good. People had jobs. People were spending money. People spending money means they need more goods and products and services. When that happens, companies boost production to sell more. When they boost production to sell more, they hire more people, expand their plants, creating more jobs. And when they sell more goods, they make more money that goes to their bottom line, and their stock price goes up. It's the way it's always been. You can talk about it and go, if you want to go back through all, I mean, I have all my old economic books. I mean, if you want to go back and search through all that stuff, that's fine. But that's how it's always worked. So, all of a sudden, doesn't work that way anymore. All of a sudden, since 2010, all of a sudden, since the Fed. And let us not forget, folks, that the Fed has, regardless of what they do with this QE, which we're now at 65 billion. That's wonderful. We're reducing the amount in which we print. That's a wonderful thing. The problem is, let's not forget, they've got over $4 trillion on their balance sheet. They've got to get at least $3 trillion, in my opinion, off. Maybe even a little more than that. But they've got to get just over $3 trillion off the books. How are they going to do that? Is that going to cause a disruption in the market? Well, not if the economy is thriving, it's not. Not if the markets are thriving as a result of a thriving economy. It may not cause a disruption if they do it gradually. But if the numbers aren't real, at some point in time, it's got to catch up, because you've got to stop pedaling the bike at some point. And when you do, it's going to fall over. So, make no mistake about it. Anyway, we're going to get to calls right after this. 866-300-9298, 866-300-9298. You're listening to American Family Radio Network Financial Issues. I'm Dan Celia. It's great to be here. We'll be right back.